All right. Well, hey, happy Friday, everybody. Hope everyone has had a fantastic week. The sun is shining. It's warm outside. If you guys have seasonal allergies like me, you might have sneezed a couple times this week, but that just means that spring is on the way. So we're going to have a quick conversation today about, I really want to go buy a house, but in this competitive market, I might have some concerns that if I put my house up for sale, there's not going to be anything for me to buy. Or maybe your concern is I don't have an option, or sorry, if I'm a contingent buyer, meaning that I have to sell first, what seller would ever consider my offer, because there's just so much competition right now that a seller would probably elect something that was a little bit less risky. So I brought in my friend today, Brad Lingle from Guild Mortgage. Brad, say hello to everybody.
Hello, everybody. Thanks for having me, Scott.
Always good to see you. And so Brad's one of our lending partners, and we had a conversation a few weeks back about this same topic. Was, look, we've got plenty of people that we talk to that say, I want to get out of the house that I'm in, but I'm afraid if I put my house up for sale that I'm going to be homeless. So what can we do to solve that? Brad gave me a couple ideas with that. I'm thinking, well, look, if we're having these conversations internally, there's probably other people out there that have these same questions. So we're just going to have a couple minute conversation today around all of that. So Brad, just as we get started, just tell everybody a little about who you are and your background and whatnot.
Okay. Well, thanks, Scott. So I'm working with Guild Mortgage out of our Folsom branch. I've been doing loan originations for 18 years now. And we have a great team, and we strive to help people make sound financial decisions and maybe think about things a little bit differently than just what's a 30-year rate. So we always try to come up with different ideas. And obviously our conversation that we had was, what do we do in a marketplace where it's really tough to get somebody in to a house? And there's different creative ways to put it together if people are willing to listen to options.
Okay, awesome. So let's just kind of get going into this then. So one of the gifts of what's going on right now is that homeowners have more equity in their home today potentially than they ever have. And because interest rates are so low on the home that they may be considering buying, it's more feasible than ever before that they could potentially qualify for two loans at the same time, both the home that they're in now plus the home that they'd want to go out there and buy. So Brad, let's just kind of start with that. Is if someone, how does that part work?
Yeah, well, the idea, most people, when they want to buy a new house, are going to want to sell their current property. They're going to use the equity or the proceeds from that sale as a down payment on a new house. And normally in a traditional normal market, although I don't know what normal is anymore, that's the way it would work. It would line it up. But because of this essentially mass migration of people, and now you have a lot of people that are looking to move and very low inventory. We're seeing a lot of the problem is that sellers don't want to accept a non-contingent offer. Most likely, Scott, you know more sellers than I do, but the reason is that they also are going to try to be non-contingent. So everything along the way is non-contingent. So one way that we could do the new loan not being contingent is to get everyone comfortable with maybe coming up with a different source of a down payment than the primary residence. If you had a different way to come up with a down payment, then the next step would be, can we get the loan approved carrying a couple of different mortgages? And then how do we shorten the time frame where people have this emotional conflict with potentially having two mortgages?
Okay, so let's talk about this. Let's talk about the source of the down payment then for a second. So I know, knowing you well enough, I know that you just have bags of money laying around the house. But let's just say for the other people out there in the world, if they needed down payment money, they could tap into something. Maybe they have a savings account that they could pull from. Potentially, they've got a 401k. They could borrow money basically from themselves by taking a loan against their 401k. Any criteria around how those 401k loans work?
Well, every 401k loan is a little bit different. I really want to focus on the one word you said, which is a loan. A loan does not have any tax consequences. You pay yourself back actually at interest. If you take it as a withdrawal, you will incur a 10% penalty. The CARES Act allowed for you to take a penalty-free withdrawal through the end of last year. So that's over and done with. So if you're going to look at your 401k, you got to talk to the administrator. Not every single one allows you to pull money out, but typically you can pull up to $50,000 or 50% of the account balance as a loan.
Okay, so again, so you're borrowing money from yourself, essentially. It's that you're going to take some money out of your 401k to use for the down payment. And then we're going to talk about in a second how to pay that money back. But then down the road, basically, once you go back and you sell the home you're presently living in, then you pay your 401k, you pay yourself back that $50,000 you borrowed, and your retirement account is then back fully intact.
Right. And one thing I like to think about is that I don't like to think of borrowing money from your 401k. You're not buying a car. You're not buying a depreciation. You're not buying a liability. You are merely transferring investment dollars from a 401k to an appreciating property of real estate. So it's a mindset difference. We're not, you're not blowing it on a new dog or a pony. You're buying a home, and that's going to appreciate in value.
But I want a pony.
Actually, that actually happened to me sometimes. They pulled money out of their house because they wanted to buy a new dog. And I said, that's your choice. I think it's a poor decision, though.
All right. Well, we'll talk about financial strategies later on. Okay. So then one of the other things then is, can you get a gift from a family member for a down payment as well?
Absolutely. The Bank of Family is a great way to do a help with a down payment. There's no tax implications for a gift. And then it's an easy way to source it in. And that's a fantastic way to avoid using your 401k. If mom or dad or uncle or aunt or grandma will help, for sure. We use that all the time.
Okay. So again, guys, just to kind of recap, just thinking about, because interest rates are so low, there's the opportunity now maybe that you really do qualify for 2 mortgage payments because your debt to income ratio is lower than maybe what it was in the past. And if you're struggling to try to figure out, well, I still need some money for the down payment, we just kind of gave you 3 ideas. So maybe it's a personal savings account, maybe it's coming out of a retirement account, or potentially getting a gift from a family member. Yeah. So Brad, one of the things that we talked about that you were talking about the other day was this recastable loan. So give us kind of the definition of what a recastable loan is.
Okay. So a recast loan is kind of a concept that not every lender has access to. So you got to talk to your own lending institution. But Guild has this program with Fannie Mae and Freddie Mac. Those are the purveyors, the buyers of loans in our area up to $598,000. It's what's commonly known as a conventional loan. So what Fannie Mae and Freddie Mac will allow you to do is after 6 months of the first year that you bought a house. So if you buy a house today in February, that puts you in, July. After you've made 6 months, you can pay down the principal balance of your loan and by at least $10,000. Fannie Mae will allow you to pay down the balance. But the beautiful thing is that they will allow you to recast or re-amortize your payment. They actually say, okay, it's like as if you put all that money down to begin with. So now we have that situation we talked about earlier, where you have someone who is buying a new house before they sell their old house. Well, now, after they bought the new house, they sell their old house. Now they have a bucket of money. They have to just wait that 6 months. So it's not 30 years anymore, it's 6 months. You can apply that money to the mortgage payment or the balance. It will drop your balance and reset the mortgage payment. Now, the one thing I want to mention is that what we're talking about here is short-term financing. So we're really only talking about 5% down. In some cases, you could do 3, but it's really, we're not talking 20% down. So it's not a huge amount of money. So the way I normally do this is that someone puts down the minimum that they can put and still be comfortable and still qualify. And then immediately upon selling their house, they're going to pay their balance down to 20%. And you're going to knock out mortgage insurance immediately. Mortgage insurance can be removed immediately if you pay down the balance to 80%. Then we're going to maintain at least $10,000. We're going to sit on that till you get to that 6-month marker. And then you're going to apply that at least $10,000 to the new mortgage, and it will reset the entire mortgage, drop your payment, and then you're home free. There's no cost. The interest rate stays exactly the same as it is. And it's just a reset or a recast of the loan through Fannie Mae or Freddie Mac.
Okay, so so what came to mind then is just kind of giving a real life example of that. So let me just kind of roll this out. Is let's just say that you've purchased this new home. Now you're coming back to sell your existing home, And let's just say that from the new house that you bought, you had a loan amount of $500,000. Okay, that's your loan amount for the home you bought. You go back to sell the home you're presently in, and let's just say you have $100,000. You walk away with $100,000 as your gain from that. You can then, after the 6-month period, you take that $100,000 that was your equity, you apply that against the loan on the new house, and now you dropped your loan balance from $500,000 down to $400,000.
That's right. And your payment's going to drop too, as if you put all that money down to begin with.
And that's the key part with this one, is that the payment drops with it. Because if you're a homeowner now, you always have the ability to pay down extra principal every month if you chose, but your monthly payment on that loan doesn't change. What Brad's talking about on the recast now is that rather than your payment being based upon a $500,000 original loan, it's now being assumed it's a $400,000 loan, thus dropping your payment by X amount of dollars per month.
Exactly. You said it perfectly. And it's a way, and the thing that I want to really make sure that everyone understands is that this is a concept that we shorten people's comfort level for having a higher payment than maybe they would normally want on the new purchase to just that 6-month period. You just got to hang on for 6 months and you can have what you want because you'll be able to reset it. So I try to get people to not think that this is the payment that they're going to have forever, because we are going to be able to drop that payment if they don't do the recast. I mean, I suppose you could always refinance, but now you're going to incur $4,000 worth of fees and you're going to take a market rate. And after this week's rates, who knows where they're going to be. So this is a way to get people's mindset to shorten the term, that they just need to, theoretically tighten their belt buckle for just a few months, and then they can reset everything.
Okay, and so that's awesome. So now we kind of gone through the assumption that they could figure out that they qualify for 2 payments by having a down payment from savings, 401k, gift money, something like that. We've got kind of this recast, but now the objection that I know that I've heard from a lot of the clients is, but Scott, I don't want to make 2 payments. Like, I understand I qualify for 2 payments, but I don't want to make 2 mortgage payments. Well, here's the good thing in the market that we're in right now is that because things are moving so quickly, if your home is priced right, if it's positioned properly in the market, you're not going to have to make 2 payments. And here's the reason why is, so let's just take the example that you were closing escrow today. Today's date is
26.
February the 26th. So the home that you're going to purchase, you're closing escrow today on February the 26th. Your first mortgage payment on that home that you're buying isn't due until April 1st. Well, in fact, it's not even really due. It's due on April 1st, but it's not late, depending on your lender, until April 10th or April 15th. So what the strategy that we're using with our clients right now is to say, okay, let's be ready to put your house on your resale home, the one you're exiting. Let's get ready to go on the market right away. So as soon as you close escrow on the one, this one's ready to go. Well, for us, I just pulled our stats the other day. Our average days on the market over the last 90 days, it's only really taking us 4 days to put your home into contract, to get an offer on your home. And then we're closing escrow 30 days from there. So I'm going a bunch of numbers and dates to you, but here's the reality is that we can get your house on the market, we can get it into escrow, and we can get it closed within your money back in the bank before that next payment's even due on the home that you just purchased. So then taking away that fear of, hey, I'm going to have to carry 2 mortgages for an extended period of time, make 2 mortgage payments. Meet with us in advance. We'll help you put together that timeline so that fear just goes away and you never have to worry about making those 2 payments.
Hey, Scott, I was going to say, I think it's really valuable that you brought up the number of days on the market, at least that your team is taking to get in the contract, because people that are doing this, it's a little bit more of an aggressive approach. But times like this, if you want to move and you really want a particular house, I always ask, how bad do you want the house? Because if you really want a particular house, and you really need to move for whatever your circumstances are, you are going to have to do something a little bit different and maybe a little bit uncomfortable. However, you can counter that uncomfortableness. You can counter that anxiety by looking at the statistics and taking it away from the emotion and saying, listen, statistically, it should take less than a week for me to get my house into contract. And then even if you have a really long escrow, it's not going to take that much longer than 30 days. And there's a lot of time in between there to do a lot of maneuvering. And so kind of banking on some statistics and that, you are a great realtor, you will guide them and get it done before they ever hit those two payments.
Yeah. Yeah. And I think, well, let's just be honest. Not all real estate agents are the same. Not all lenders are created equal. So to go through a strategy like this, you have to have the right team on your side. I happen to know a fantastic real estate team. I happen to know a fantastic lending partner. So this is where we kind of sit down and go through that strategy. How would we structure this? What would those payments look like? Just so that all parties are comfortable and going into this type of a situation with their eyes wide open. So good point there, Brad. So let's move forward. So let's talk about the bridge loan. So tell me what a bridge loan is.
So generally speaking, a bridge loan is a short-term loan meant to bridge the gap between two transactions. So again, we're still talking about selling your house first and then needing that money for a down payment on the new house. Well, if there's no 401k and grandma can't help out and we don't have savings, then what we can start looking at is a bridge loan. So a bridge loan is kind of a general concept. There's really two ways to do it. One would be just a standard good old line of credit as a second mortgage on your current house. Any of the local credit unions, I prefer Banner Bank because I have a great relationship with them and I like their service levels. But any of the local banks, the credit unions will offer a line of credit very, very cheap. And then you can use that line of credit as a second mortgage and just basically write a check from that as your down payment onto the new house. The other way to do a bridge loan is you can get a private money source. Guild just released our own internal bridge loan. And basically what that is, that's a short-term loan that's attached to your current property. There are some details obviously about that, but that loan would be attached to your current property. You could then use that money for the down payment on a new house. So we're going to be, instead of Aunt Jenny, it's going to be Uncle Brad that's going to be giving the money. So it's a private note attached to your house. And then when your house closes after the new purchase, that loan would be paid off. So we're trying to create ways or come up with assets to be used for the new purchase.
So the bridge, okay, so let me just say that kind of the way that I heard it is, if you don't have the money for the down payment from these other sources, so the savings account, the 401k, grandma, or whatever, but you have equity in your home, in the home that you're going to potentially then be selling down the road, you can tap into your equity in this form, either by doing an equity line of credit or on this bridge option where you are your own bank in that sense, to take that, to use the equity that you have in the home, to use that as the down payment on the new one. And then again, you come back and you sell. Once you buy the new one, you come back and sell the one that you are exiting.
Exactly. And both of those loans, a line of credit and at least Guild's bridge loan, would be attached to that property that's going to be sold. And then it just, you would pay it off when you sell that house. So they're great. They're both really great ways to, again, tap into your equity. People that would be great for those type of loans are someone who has a lot of equity tied up in their house, but just doesn't have the liquid funds elsewhere for a down payment. So if you've been in your house for 20 years and you have $200,000 in equity, but you don't have the funds for the down payment, that's a great way to tap into that equity and use it. You're kind of dipping your hand in the cookie jar before you sold that house.
Before you ate dinner. You're having dessert before you ate dinner.
There you go. That's a great analogy.
I don't know if that's the right analogy or not, but I don't know. It just made me think of it. Now I want a cookie.
Okay.
Okay, so again, like why we want to bring this up is that this is just a common objection or a common concern that a lot of our clients are voicing to us right now. Look, Scott, we really want to move. We just don't have confidence that we can find it. If we sold our house today, we're afraid we'd be homeless. And so if that's you, so maybe it's time, maybe you need an extra bedroom. Maybe the family just got bigger. Maybe you're like us, you got a kid away at college and now you're in a house that's too big. Whatever it happens to be, whatever your motivation happens to be, if you're ready for a new house and you're concerned that your existing home is what's holding you back, give us a call. Let's sit down and just have a conversation to see if any of these options that we just discussed would be the right fit for you. And I'm not going to just say that, hey, this is it. This is the end all be all. This is not for everybody. And yet this will work for a large segment of who our clients are out there. So if you want to find out more about how this works, what the payments would look like, what the qualification process would look like, or you just want some more clarifying questions answered as we went through today, feel free to give me a call. I'm happy to meet with you face to face. Brad will come out and meet, or we'll all hop on Zoom together. And let's see if this type of a scenario would work for you and what your goals are for real estate in 2021. So Brad, hey, I thank you for coming in. I appreciate your knowledge. I appreciate your partnership. And if you guys need to get a hold of Brad, just ping me, and I'll put his info here in fact, let's just do this, Brad. What's your phone number?
My phone number is 916-932-0257.
Say it one more time.
916-932-0257.
All right. Thanks, buddy. So anybody out there that wants some questions answered, give us a call. Let's see if this would be a good scenario for you. And until we speak again, have a fantastic day. See you, Brad.
Thanks. See you, Scott.